Hi, my name is Piotr, and today I will explain, in my opinion, the best way to invest money if you are a beginner or if you are not looking to do big analysis of the businesses. We will focus on investing in government bonds and in stocks. The goal of this podcast is to share free financial education worldwide because fuck living rich and dying broke. So, we will start with the basic principle of you have to save money in order to invest first. So every month or every couple of months, look at the sum of the money on your bank account and see how much of that money you can invest later. So for instance, to feel comfortable, you need to have 3,000 on your account. Everything else you can invest. Okay, so that's the money that you are going to be investing. And then, depending on your risk profile, how much risk and how much reward, how much money you want to earn from that investment, you can look at two different instruments. The first is government bond. I will explain it in a second. It's a safer one. And the second one is a stock. We are going to be looking at stock market indices. Those are instruments that hold many stocks at the same time. So you will be buying the whole countries, not single individual stocks like Apple, Tesla, or Amazon. You are going to be buying 500 biggest companies from USA all at once, and you really don't need a lot of money to buy that. Those funds can cost even sometimes less than $10. But let's start with bonds. They are the safest option you can pick. The bonds work in a way that you lend money to the government. Let's say you give $100 to the government, and after a period of time, let's say 1 year, the government will give you the money back plus interest. So it's a debt. You give debt to the government spends this money, and after a year, he has to give you back the money plus some interest, and that interest is your profit. And it's a very safe way, because you cannot really lose money while investing. There are only some small probability things that can happen in order that you lose money while investing in government bonds. So you can lose everything if your government will go bankrupt. It can happen. It's very unlikely, but it can happen. I will later show you a good indicator to see if it's safe right now to invest in those government bonds. So that indicator is called debt to GDP ratio. So if you live, let's say, in the USA, you should Google USA government debt to GDP ratio, or China government debt to GDP ratio, or Poland government debt to GDP ratio. And you can very easily find this indicator. It will usually be on a chart. So you can see that ratio over last 10 years, let's say. And if this ratio is super high right now, Japan has this ratio of 200%, meaning that the debt of the government of Japan is 200% of the GDP. So it's twice the GDP of Japan, and it's a very, very high debt to GDP ratio. And Poland, for instance, it has debt to GDP ratio of, I think, nearly 50%. So it's much, much safer. And you can compare that indicator through time. So if you can see that the debt to GDP ratio is rising in last years, that can be a bad indicator for the future. For instance, the Japanese debt to GDP ratio was rising, I think, since 1995, and it started small but continued to rise, and now Japan has one of the greatest debt problems in the whole world. They have so much debt, the government has so much debt, it's not really safe to invest in those Japanese government bonds. You want this investment to be safe. You don't want to lose all of your money, which can happen if your government goes bankrupt, and your government can go bankrupt if they are managing the money in a bad way, if they are borrowing a lot of money, and if they have a lot of debt. So you have to check that. You have to compare it maybe with other countries and with the past debt in your country. So for Poland, for instance, we have a constitutional debt limit that is 60%. So we all are always, or at least has been in the past, below that level, and it's a safe level to be in. And your country should also have that ceiling, that debt limit that should be around 50-60%, and then it can be safe to invest in those bonds. It also depends, the risk also has to be looked at terms of risk and reward. So when buying government bonds, you can also look at the interest rate that this bond will pay you. So for instance, if you are only going to earn 1% every year, well, that's really not a good investment. But you can get the bonds that will pay you 5 or even more percent. It always depends with, it correlates with risk. So if you are going to buy USA government bonds, your interest rates will be lower because the risk is lower. And if you are going to, if you live, for instance, in Asia or in Africa, in some third world or second world country, where the risk of your government going bankrupt is higher, you will also earn more money because it's called risk premium. And you can buy those bonds on any, usually through banking sector or through government websites. And nearly every country has access to those government bonds for individual investors, but the way to buy it can differ. In USA, I think you can just go online and buy the bonds online. In Poland, you can buy them through your bank. It's very easy and everything can be done online. And opposite to that, we have the stock market investments, where we buy businesses, where we buy companies, and that gives us more earning power. You can earn more money doing that than investing in bonds, but you can also lose money more easily because the prices of bonds, they can change. You can buy a bond for $100 and after a few months the price can go down to, let's say, $80. And if you sell your bond before the full year or the whole period, because sometimes the bonds are for 5 years or 10 years, if you sell that bond before like the whole time, it's called maturity. So if you buy a bond for 10 years, 10-year bond, and you decide to sell it after a year, the price of the bond can be lower than the initial purchase amount. So you can lose money this way also on bonds, but the stocks, they are more volatile. And on the bonds, after the bonds mature, so if you buy 10-year bond and hold it for 10 years, you are guaranteed to get your money back, 100% of your money back, so that $100 plus all of the interest. The price of the bond can only change short term if you sell it before it matures. And with the stock market, well, the prices of stocks, as you know, they can change daily, and it's normal for even those indexes that I will explain in a moment to go down 20, 30, or even 50% down in a matter of weeks, sometimes during stock market crashes. So you really need to be careful, and you need to understand that you are taking on risk. So that has to be free money that can just be put on the stock market to work for 5 or 10 years, maybe even. So you don't have to care about the volatility of the price going up or down short term. It will go up, it will go down, and that money just has to stay there in those indexes and keep on working. So you can buy the stock market index through your broker or through a bank, and it will offer you a way to invest in businesses without doing in-depth analysis. And you will buy all of the biggest companies all at once. So for instance, there is this index S&P 500, and it holds 500 biggest stocks from the USA. And you can invest into that index through something called ETFs, index ETFs. They offer you a way to buy small fractions of all of those 500 companies, and they charge very little commission. So while buying ETFs, you will pay a little bit of money every year. So for instance, if you buy an index from USA, that ETF, that fund will charge you around 0.03% of your money every year. If you buy Chinese index, you will pay around 0.5% of your money every year. So if you invest $100 into Chinese index that has an expense ratio of 0.5%, every year that fund will charge you 50 cents for the management of your money, and it will be paid instantly. Just your money that is invested will go down a little bit. And that index can be analyzed by you a little bit. It's a more in-depth approach where you look at the price to earnings ratio of that index. So it's a ratio that tells you after how many years you will double your money. So if a Polish index, let's say, has a P ratio of 10, that means after 10 years you can expect to double your money. But it's a very simple indicator, and it doesn't account for things like growth, for instance. So it only looks at the earnings from the biggest companies in Poland in the last year. And in the future, maybe the earnings will go up, or maybe they will go up. We don't know that. It's just an estimate based on the current results. So if you are looking to invest into that stock market index over the period of next 10 years, if the earnings in the economy is going through some slowdown in the last year, then the P ratio can be bigger. And that doesn't indicate that the slowdown of the economy will be going on in the future, in the next 10 years. And also sometimes the stock market can crash, and it's a really good opportunity to invest because the prices can go down even 50%, and that can be a great opportunity to buy a lot of stocks. And if the PE indicator of the index that you are trying to buy is very high, then you shouldn't purchase it. For me, if I look at the index of a developed country like USA or Germany, I wouldn't buy that index if the P ratio is above 20. And for third world or second world countries, I wouldn't buy if the P ratio is above 15. Like standard P ratio for third and second world countries like Poland or China is around 10, while for USA and Germany it's around 15. And now I will tell you a few names of the indexes that you can look for. So from China we have ASI.FR or XCS6.D. Those are two indexes from China. The XCS6.D is an index that specializes in the technological sector, while ASIFR is an index that is a broad market index that invests in all of the companies from China. From Poland, we have ETF BW20TR.PL. That index invests in the biggest 20 companies from Poland. From the USA, we have IUSA.TE. From Singapore, XBAS.DE. From India, NDIA.UK or QDV5.DE. So you can look at those ETFs. Those are the ETFs that will let you buy those indexes, and depending on your risk profile, you can buy more bonds or more indexes. So, summing up, I will also give you some examples. So, let's say that I don't want to take a lot of risk while investing, but I want to multiply my money, I want to make some profits. Then I would invest 75% in government bonds after I check the debt to GDP ratio of my country to make sure that my country won't go bankrupt, because then I would lose all of my money that I invest into bonds. And I would invest 25% into indexes, and I accept that the price of those indexes can fall down even by 50% during stock market crashes, and that is normal. And I also accept that I have to invest in a long period of time, and I shouldn't worry or act because of the price changes. And I maybe will buy the Polish and USA index after I check the PE ratio. So right now, the PE ratio for the Polish index is around 10, so it's perfectly fine to invest, while for the USA, it's above 20. So I don't really like that. I don't think I will invest. Maybe I'll look at some other indexes, let's say China. Maybe I will buy ETF that holds companies from China. Okay, they have a good PE ratio that is also around 10. The same with Singapore. For India, well, right now it's quite expensive. It's above 20. So for not the biggest economy in the world, paying so much money for the Indian companies, it's not good. It's not good in my opinion. So yeah, I will spend 75% bonds that will secure my money and give me a little bit of profits, and I will invest 25% into the stocks to get better returns. Okay, and what if I want a lot of money, if I accept greater risk? Then I will maybe invest only 50% or 40% in bonds or even less, but I will still invest at least 25% in bonds. It's a rule from Benjamin Graham, the teacher of Warren Buffett, one of the greatest investors. I will not go into detail about this rule. Right now it's information for the next episode, but basically you need at least 25% of bonds in your portfolio, because when a stock market crash comes, you can sell those bonds earlier and buy a lot of cheap stocks. So I will buy at least 25% of bonds. That will also give me money that I can easily get out of that investment if I need this money. So for instance, if I get sick, I can sell my bonds and I will get my money back, while the stocks, well, they can go down a lot. Maybe it won't be a good time to sell them, while bonds are more stable. So 25% in bonds and 75% in stocks, because stocks over a long period of time, they give better profits than bonds. They are more risky because the price can change very rapidly, but I accept that I'm not planning on touching that money for the next 5 or 10 years. So I'm fine with investing 75% into the stocks. And for everyone from both of those examples, you have to repeat this process maybe every month or maybe every quarter. Just look at the free money in your bank account, think about the stock market, look at the PEs of the indexes, and just every month or every quarter buy those bonds and buy those indexes. And I would also look at the emotions that are among the stock market investors. If the stock market rose up, if the price of the stocks went up a lot, that usually indicates that there is a lot of greed, that a lot of buying is taking place, a lot of people are buying, which might not be the best time to buy. Maybe the PE will be high, like in India we can observe now that the stock market had a huge rally, the price went up, but that also means that the PE ratio is really bad, so I won't invest in that. While if we look at depressed markets like China, right now it's nearly December 2023, so the price dropped down. I want to invest then. I don't want to invest when everybody is optimistic. When the price is going up, I want to invest when the price is going down, actually. Of course, you also have to look at the opportunity for growth in the future. Maybe there's a good reason why the price is going up or going down, but still I feel more comfortable investing in something that has PE ratio of 10 years, so I can expect to double my money in 10 years, than something that has PE ratio of 20 years, where I can expect to double my money in 20 years. Of course, that doesn't account for growth, but both China and India, if you look long term, they have great way to grow, for the companies to grow and create more and more profits for me. Okay, I think that's enough for this little episode. I hope it will be a nice, good way to look at the two most basic ways to invest in bonds and in stocks for the beginners, through government bonds and through ETFs, through indexes. Thank you for listening, and always remember, fuck living rich and dying broke. Peace.